18 months, that's the time you have to reposition your portfolio before the next major wealth transfer occurs. From the unprepared to the prepared. Not 2 years, not 5 years, just 18 months. I've spent 50 years studying debt cycles. I predicted the 2008 crisis. I called the dot-com crash. And right now, every indicator I follow is flashing red. We are in stage 7 of an 8-stage debt cycle. The final stage can wipe out 50 to 60% of conventional portfolios. But it doesn't have to wipe out yours. Only 4 investments can withstand what's coming. 4 and only 4. In the next 20 minutes, I'll show you exactly what they are, why they work, and how to own them before this narrow window closes permanently. Here's what few people will tell you. These cycles occur roughly every 75 to 100 years. The last one was in the 1930s and 40s. And when they conclude, they don't do so quietly. They end with enormous wealth transfers from those holding the wrong assets to those holding the right ones. I'll reveal exactly which 4 assets preserve wealth when everything else collapses and how to reposition your portfolio before it's too late. But first, a story that highlights why this is so crucial. In 2006, I met a man named Richard. He was 54, a successful engineer with $1.8 million saved over 30 years of disciplined investing. He followed all conventional advice, 60% stocks, 40% bonds, working with a top wealth management firm, paying nearly $20,000 a year in fees to be told to stay the course. I explained to Richard what I'm sharing with you now. We were late in a debt cycle. Housing was over-leveraged. Banks held toxic assets nobody fully understood. A crisis was imminent. He needed to move into the 4 assets that actually survived these events. Richard didn't listen. His advisor dismissed my warning as alarmist. They presented charts from the last 40 years showing stocks always recover. They said fundamentals were strong, diversification would protect him, and my concerns were exaggerated. Richard stayed the course. 2007 came. The market continued to rise. Richard felt vindicated. His portfolio reached $2.1 million. He began planning early retirement. His wife selected a vacation home in Florida. They booked a Mediterranean cruise for the following year. Then 2008 struck. In just 18 months, Richard's portfolio lost 54%. That $2.1 million dropped to $970,000. Everything he had built over 3 decades was cut in half. At 56, he had little time to recover. His advisor said, "Don't panic, don't sell, it'll come back." But Richard couldn't wait. He needed that money to compound for retirement. The market fully recovered only in 2013. By then he was 61, and his retirement calculations showed a shortfall of over $800,000. Retirement was pushed from 65 to 67, then to 70. I saw Richard last year, now 72, he's still working, not because he wants to, but because he must. The Florida home never happened. The Mediterranean cruise never happened. His golden years became his working years, and the hardest part, Richard wasn't reckless. He followed the rules, trusted the experts, did everything conventional wisdom recommended, and it destroyed him. Meanwhile, the advisor retired at 58, lives in Palm Beach, and plays golf 5 days a week. Here's the truth. You may have only 18 months to reposition your retirement portfolio. The economy is not random. It operates like a machine driven by 3 forces: productivity growth, short-term debt cycles, and long-term debt cycles. Productivity growth is simple. Are we producing more value per person than last year? If yes, the economy grows. If no, it stagnates. Short-term debt cycles last 5-8 years. Borrowing increases, spending rises, the economy heats up, central banks raise rates, borrowing slows, spending slows, the economy contracts, rates fall, and the cycle repeats. This explains recessions every 7 to 10 years. They are not random. Underneath this, a longer cycle operates unnoticed by most, the long-term debt cycle. Over decades, government, corporate, and consumer debt accumulate until it becomes unsustainable. You can't service it, you can't grow out of it, you can't refinance because rates are already near historic lows. That is exactly where we stand in 2026. Total U.S. debt, government, corporate, and consumer, exceeds $90 trillion. Government debt alone is $38 trillion, 125% of GDP. The federal government now spends over $1 trillion annually just on interest payments, more than defense, education, or infrastructure. When interest costs exceed defense spending for the first time in modern history, it signals a critical problem. The debt load is unsustainable. At the end of a long-term debt cycle, you have 3 options. Defaults. Governments, corporations, or individuals stop paying, leading to massive bankruptcies and wealth destruction. Restructuring. Debts are renegotiated. You owed $100, now you pay $50 over 20 years. Nice for debtors, disastrous for lenders. Inflation, money printing devalues debt. $100,000 owed today may be worth a fraction in 10 years, beneficial for debtors, catastrophic for savers. Central banks always choose inflation. They may disguise it as quantitative easing, stimulus, or monetary accommodation, but it's always money printing. When this happens, the dollars in your bank account or retirement portfolio lose significant purchasing power. I've studied 500 years of economic history and mapped every major debt cycle since the Dutch Empire. Patterns repeat. In the 1930s, it wasn't just stocks. Government and corporate bonds defaulted massively. Stocks fell 89% from peak to trough. Only 4 asset types preserved wealth: physical gold, businesses with pricing power, short-term government securities, and productive farmland. The same pattern repeated in the 1970s. Bonds were destroyed by inflation. From 1970 to 1980, the 10-year Treasury lost over 60% of its real value, and stocks essentially stagnated for a decade. After adjusting for inflation, which ranged from 7% to 9% annually, the real purchasing power of stock investors dropped by more than half. Someone who invested in stocks in 1968 didn't break even in real terms until the early 1980s, a full 13 years of zero returns. During that time, purchasing power eroded while advisors insisted, stay the course. Meanwhile, 4 types of assets soared. Gold jumped from $35 per ounce to $850, delivering a 24-fold return. Companies with pricing power, such as energy firms, saw revenues rise by 700%. Short-term treasuries preserved capital and offered flexibility, and agricultural land doubled or even tripled in value. This pattern repeats roughly every 75 to 100 years. When debt cycles end, paper assets collapse, and only certain asset classes retain value. Let me tell you about someone else, Margaret. She reached out to me in 2011, 3 years after the financial crisis. At 68, she was grieving her husband who had passed away 2 years earlier from a heart attack. She believed the stress of watching their savings collapse contributed to his death. They had saved $1.4 million by the time he retired at 65, invested in a typical balanced portfolio with 70% in stocks. When 2008 hit, they lost over $600,000. Her husband struggled immensely. He would wake up at 3 a.m. to check account balances, stopped eating properly, and his health rapidly declined. Margaret shared her story to highlight an important lesson. The true cost of following conventional financial advice isn't just monetary, it's measured in years of your life, in health, and in seeing loved ones suffer due to misplaced trust. She said that if she could go back, she would trade every dollar of potential upside for the peace of mind provided by truly safe assets. Now let's explore the 4 investments that endure when the system falters. 1. Physical precious metals. Owning and controlling physical gold and silver, not ETFs, mining stocks, or paper gold, is essential. Throughout history, gold has survived every currency collapse, serving as the ultimate insurance against monetary mismanagement. In the 1970s, gold rose from $35 to $850, meaning a $10,000 investment in 1970 would have grown to $240,000 by 1980. The same $10,000 in the S&P 500 barely kept pace with inflation. In the 2000s, as central banks printed trillions and the housing bubble burst, gold rose from $250 to $900, a 7-fold increase. In 2025, gold jumped over 70%, silver over 140%, reflecting rising monetary stress. Allocating 10-15% of liquid net worth to physical metals, stored securely across multiple jurisdictions, acts as insurance. In case the dollar loses 50% of its value over the next decade, that gold increases in dollar terms while other assets collapse. To acquire physical gold and silver, you have 3 options. Purchase from reputable dealers like AppMax or JM Bullion, use allocated storage services such as Bullion Vault, or buy from verified local coin shops. Focus on bullion, not collectible coins, and expect a 3 to 5% premium above spot for gold and slightly more for silver. 2. Businesses with pricing power. Look for individual companies, not stocks or index funds, that meet 3 criteria. Ability to raise prices faster than inflation, generate sustainable cash flow, own hard assets or intellectual property that retains value during currency debasement. During the 1970s, while the S&P 500 stagnated, certain energy companies' revenues surged 700% as oil prices jumped from $10 to $80 per barrel, while costs rose only modestly. utilities with regulated returns, and consumer staples with strong brand loyalty, such as Procter & Gamble, Johnson & Johnson, and Coca-Cola, could pass rising costs onto consumers without losing demand. These are not get-rich-quick investments. They are wealth preservation tools. Allocate 30-35% of your portfolio to companies that combine hard assets, pricing power, and dependable cash flow. To identify these businesses, examine dividend aristocrats, companies that have increased dividends for at least 25 consecutive years. Focus on consumer staples, utilities, and healthcare sectors, and diversify across 6 to 8 companies with payout ratios below 60%. 3. Short-term U.S. Treasuries. Although seemingly boring, short-term Treasury securities, 90-day to 2-year bills, and cash equivalents are crucial. They provide liquidity and optionality, enabling you to act during crises. For example, in March 2008, high-quality corporate bonds traded at 60 cents on the dollar. 12 months later, they returned to par, generating 60% returns with minimal risk. Similarly, during the March 2020 COVID panic, those with cash could deploy it at market lows and double their money in 6 months. Maintain 20-25% of your portfolio in short-term treasuries or cash, earning 4 to 5% with full liquidity. Rates won't stay this high forever. Lock in these returns now before potential cuts by the Federal Reserve. The easiest way to invest safely is through Treasury Direct, the official government website. You can open an account for free and purchase Treasury bills directly without paying any fees or commissions. One strategy is to set up a ladder where bills mature every month, giving you consistent access to cash. Alternatively, you can use a brokerage account to buy Treasury ETFs. For example, the ticker SOV holds short-term Treasury bills, specifically 1 to 3 month bills. These ETFs trade like stocks but consist entirely of government securities. For cash equivalents, consider opening a money market account at Vanguard or Fidelity. Their Treasury money market funds currently yield around 4-5%. Your funds remain liquid, you can withdraw at any time, and they are fully backed by Treasury securities. Another secure investment is productive real assets that generate income. These include agricultural land, rental properties, infrastructure, and farmland, essentially assets that produce food, shelter, or energy. Such assets remain valuable even when currency or paper investments falter. During the 1930s depression, farmland held steady in real value while stocks and bonds collapsed because food production remained necessary. Similarly, in the 1970s, agricultural land increased significantly in value as food prices rose, and rental properties performed well as rents kept pace with inflation. Real assets are secure for 2 main reasons. First, they generate consistent income. A farm produces crops, a rental property generates rent, regardless of the market value. Second, they are tangible. Farmland and rental properties cannot be created out of thin air, and demand for food and shelter is constant. A recommended allocation is 10-15% of your portfolio. For most investors, this means investing in real estate investment trusts, REITs, that own income-generating properties. If you want to invest in farmland, consider Gladstone Land Corporation, LAND, which owns farms across the U.S. and leases them to farmers, with a current dividend yield around 3%. Farmland Partners, FPI, operates similarly. For residential real estate, Realty Income O owns over 11,000 properties and pays monthly dividends, having increased them for 29 consecutive years. For diversified exposure, the Vanguard Real Estate ETF, VNQ, holds hundreds of REITs across residential, commercial, industrial, and healthcare properties. Direct ownership of rental properties or farmland is ideal if you have significant capital and expertise, but REITs offer exposure without operational responsibilities. The 4 core assets to preserve wealth during a debt cycle crisis are 10-15% in physical gold and silver, 30-35% in businesses with pricing power, 20-25% in short-term treasuries and cash, 10-15% in productive real assets. This allocation covers 70-90% of your portfolio, leaving 10-30% for intelligent risks based on your age and expertise, such as emerging markets, commodities, or technologies you understand well. The core portion is defensive, designed to withstand economic downturns. A common mistake is understanding the strategy but acting too late. People sell everything when markets rise, buy gold, sit in cash, and miss potential gains only to see the market continue upwards. Here's a systematic approach. Step 1. Calculate your timeline. How many years until you need the money? If you're 35, planning to retire at 60, you have 25 years and can reposition gradually over 12 months. If you're 58, retiring at 65, reposition faster over 3 to 6 months. The closer you are to needing funds, the faster you act. Step 2, sell speculative assets first. Start with meme stocks, cryptocurrencies bought due to trends, or growth stocks with extremely high valuations and no profits. Then trim overweight positions, such as excessive index fund exposure. Don't aim for perfect timing, just systematically reduce exposure to vulnerable assets. Step 3, build the 4 safe buckets gradually. Month 1, buy 5% of your portfolio in physical gold and open a Treasury direct account. Month 2, purchase 2 pricing power businesses, e.g. Procter & Gamble and Johnson & Johnson, and allocate 10% to Treasury bills. Month 3, add 2 more businesses, perhaps a utility or healthcare company, and increase short-term treasuries. Month 4, add silver and raise total gold, silver allocation to 10%. Month 5, increase real asset exposure via REITs or Farmland ETFs, and add another pricing power business. Month 6, review allocations. 70–80% should be in the 4 safe assets, with the remainder in intelligent risks or cash. This phased approach averages your entry points, allows learning and adjustments, and is emotionally easier than making one major change. Step 4, ignore short-term noise. Markets may rise while you reposition. Friends and media may boast returns, but your focus is long-term survival in a 75-year debt cycle. Short-term performance is irrelevant. Many will nod along but take no action, often persuaded by advisors who benefit when you stay invested in their funds. Waiting too long can be costly. Recovering from a 50% loss at 55 is difficult because compounding won't have enough time. This week, review your portfolio carefully. Ask, if an inflationary debt crisis occurs, will this preserve my purchasing power? If not, mark it for sale. Plan how to reposition into the 4 core buckets over 3 to 6 months, and set deadlines or systems to follow regardless of market or media noise. A disciplined system prevents emotional errors. Fear, greed, and hope can destroy wealth. This strategy has worked through every debt cycle in history: 1930s, 1970s, 2008. Paper assets collapse, the 4 core assets endure. We are nearing the final stage of a debt cycle. Acting now ensures survival. Hesitation leads to losses. Start today. Open your portfolio and begin the process. Your future self will thank you.